record, share. Okay. And as you guys know, I started putting these that people could download on YouTube, along with links to the slide decks. Is everybody okay? Can you give me a thumbs up that you're fine with me putting those, posting those, that everybody can download the stuff for free or review? I'd like a thumbs up from everyone, just that way I know they're cool with it.
Yeah,
Okay,
I'm good, Alan.
Thanks, Ian. Thanks, Liz. And the only people I haven't seen are D. Garcia and Brian. You guys might have already.
Yeah, I don't see where can I click the thumbs up.
Yes. Okay, you give me a yes verbally, and I'm good.
Yes. Yeah. Yes,
okay.
for me.
Great, thank you. And Brian, you good? Call us. I might have just missed yours.
Yes, I'm fine. Yep.
Okay, great.
All good.
Thank you. Okay, and so let's see. And it is recording, right? I messed that up one time. Okay, now I'm going to give a quick poll just for some quick questions to see what you guys think. These are, these are just one, we do these on Friday, and I know it doesn't work well for people on the East Coast, and so I thought I'd see if Thursday might be better. But you can just quickly go through these, and this should just take a few minutes, but it's some of it's kind of related to the topic today. Hey, excellent. Hey, Troy, Jim, and Dustin, saw you guys just joined. Just wanted to get concurrence. You guys are good with me posting this on YouTube so that everybody can download stuff for free.
Totally. Yeah. All good with me.
Excellent. And Dustin, I know you've always said before, you're good. And then there's the poll you should see, hopefully. I know I launched it before you guys joined, but you guys all see that?
Yes. Yep.
Okay. Okay, and is anybody still working on the poll?
Sorry, I am. Just one more second.
Okay.
Off.
Yep. No, I just don't want to take up too much time if people are sitting here waiting for me.
I'm done. Deravan Garcia, I'm done.
Okay. Anybody remaining? Troy, you still working?
I'm good. Thank you.
Good. Okay. I'm ending the poll now. And let's share the results. See what. Can everybody see the results?
Yep.
Okay. Looks like Friday wins. Okay. And we don't have anybody on the East Coast. So when I ask again, we'll see if that changes, but that's good to know. Okay, good. So why I asked about the 10% is, to me, the priority is 10% on the 401k match to get that free money before an employee stock purchase plan. If you can only do that amount, that's why I asked that. Good. Everybody's already enrolled, and most people are at 5%. If you can't, hopefully you can get there soon. And because that's just another, total of 5%. Let's see. Okay, you'll see on number 5, this kind of goes into some tactics if you've already been contributing to ESPP and you haven't sold. We'll get into that during the discussion. And okay, so about 2/3 have a taxable brokerage account. I guess like you could have it just inside E-Trade. That was kind of a poorly worded question. It's just something, do you invest in a taxable brokerage account outside of just getting either RSUs or ESPP? And let's see here. Okay, wide all over the place. So the actual return on the S&P 500, which is kind of the benchmark for how the the market is. The S&P 500 is basically the 500 largest companies in the US, and the average return over since the last 100 years has been 10%. So, and that goes into why you'll see why I think the employee stock purchase plan is a good deal, because you're getting 15% return in 6 months. So you can bank that and then move on and get to capture other returns. So we'll get on with the rest of hide these results. Let's see. PowerPoint challenge apparently. Okay, here's the disclaimer. As you know, this is, I'm not providing specific advice or recommendations. This is not sponsored or sanctioned by Biosat, but this is meant to be a discussion and hopefully educational, and you find it valuable. Any questions before we get going?
No.
Okay. Here's just quickly kind of what we'll be talking about. We'll just kind of get right into it. I took the E-Trade actually does a talk on this, and some of the slides I was already going to do, I found, hey, I just used some of their slides because it made sense. Why recreate the wheel on some of this, but so some of these you might have actually seen, but they just provide the nuts and bolts. I'd like to go a little deeper if possible. Okay, so that's our stock for the last 5 years. Looks pretty ugly, doesn't it? An update that I did that on June 6th, and since as of close yesterday, it was down 31.25. I think it's up another 50 cents today, but that was another 17.7% drop just since the 6th. So it's, the question comes into like, wait, I said this is my hierarchy of savings. I've got ESPP all the way up ahead of like a max before maxing the HSA and IRA. Does that make any sense? Or, am I just an idiot and that, totally insane? Well, the reason is, I'll explain quickly so that people, in case you don't know, how does the employee stock purchase plan work? There's two 6-month periods each year. They start in January 1st through June 30th and July 1st through December 31st. And what it takes is the price of the stock price at that grant date, which is the first day, January 1st or July 1st, and then or whatever date is closest to that, if it's not a trading day. And then they take the final date of that 6-month period, being June 30th or December 31st, and whichever price is lower, we get a 15% discount, and that's our purchase price. So as you guys have seen for this 6 months, and we'll have it, our stock has been dropping actually, just like the market has. But so we'll get you actually ideally want it to be going up, and then you get a discount on that or lower price at the beginning. But that's such is life. But it's still 15% when we're currently in a bear market. The market's down 20% this year. So just by this 6 months, you'd still capture a 15% gain on the current stock value, stock price. So as I said, that's why I asked the question about what's the S&P 500 return, 10% per year. This is a 15% gain in 6 months. You shouldn't expect more than that realistically ever in the market. The market doesn't go up in a steady way. It goes up up and down very quickly, but I think you guys get what I'm saying. So why is this so good? It's free money. 15% is free money. Sure, you have to pay, potentially some taxes on it, but a salary is money. You have to pay taxes on it. Well, obviously, if you hold, you saw our stock ticker for the last 5 years. It's dropped a lot. You can ultimately lose money, but that's where we'll go into strategies of what to do with employee with this stock once you've purchased it. Any questions there?
Hey, Alan, I actually have a question.
Yep.
So for the cheaper price stock date, it's either January 1st, July 1st, or June 30th and December 31st. It's not the cheapest price during that time span. Is it just
correct? It doesn't look at the entire 6 months. It looks at the grant date, that first day of when it's open, January 1st and then this final date, June 30th. And whichever of those two dates, the closing price on that date, whichever one's lower, we get a 15% discount on it. And then the same thing for July 1st and December 31st. Does that make sense?
Yeah, thanks for that clarification.
Yeah, I wish it did.
Keep
I
us
wish it
over
did that too,
100%.
Kate, but that's not how it works, unfortunately. But it's still a great deal. I mean, it's still a minimum 15%, return for free. Okay, now getting into, okay, what do you do now you've purchased it? Within 10 days before, you could say, hey, I don't want to buy into this. But if you do buy, should you hold? We'll go into, how long it takes for these. We're going to talk about short-term and long-term capital gains, and also the similar thing with employee stock purchase plan, which is qualifying versus disqualifying. But it takes a lot longer, which doesn't make any sense to me, but that's the way it works. But a couple of things I want to point out. One, there's you don't want to put as you see, all your eggs in one basket. I'd say typically 5 to 10% is the max you'd want in your own company's stock. Granted, there's been tons of millionaires made, like you think of all the administrative assistants for Microsoft, back in the day that became, millionaires just because of their stock options. It's risk though, and only software companies tend to shoot to the moon like that anyway, but it's the smart thing. Take your 15% and then diversify it, diversify it better, and instead of just waiting. But we'll go into strategies. If you've already had this for a couple of years and haven't sold, how can you make maybe a better financial smart move to where you don't pay any taxes on it. And just so you know, E-Trade does charge $9.95 per transaction. You can move that out to your own, like I have a Schwab account. You can move that out for free. The challenge is getting the cost basis information. So I've like recorded all the cost basis, and I'll show you guys where you can get that. But you can move it out to your own, if you're a different brokerage account where you don't pay maybe for trades. But for $9.95, is it really worth it? Because it's kind of, it's probably not worth the effort, actually, really, the time. Time is money. But it's just something you can know, and I could send you guys the form where you can get those shares transferred to, a different brokerage house if you're interested. Real quick, just
Alan?
Yeah.
Question on that. Does E-Trade charge $9.95 per transaction across all of E-Trade vehicles, or if you were to transfer it internally to an individual brokerage at E-Trade and then trade it, would they keep the cost basis because it's all E-Trade and then avoid that $9.95? Do you know?
I don't think they would allow you to do that, because that's their deal with Fiaset, running this whole employee stock purchase, the stock plan. So I don't think they'd let you just move it to another brokerage account at E-Trade and get away with that. My thoughts. Maybe they would. You could call them and check, but yeah. I'm thinking if they're like, gonna be like, why are we going to let you sell this for free? And so I'm check, but I don't think that'll work.
Okay.
But hey, something important this whole max 5 to 10%, I say, of net worth in a company stock. ESPP, RSUs, our company stock match, our company match, all of those are in company stock. So it's easy. It could be easy, especially when you're young, to shoot above that 10% and have what I think is too much of your net worth being just tied up in company stock. You never know. I mean, a terrible story from the Great Recession. I had a friend who was working at some local bank and hadn't moved out any of her stock, hadn't sold any of it, had a net worth of like $750K. In one day, zero, gone. Feds came in, shut down the bank, everything was gone. It still makes me sick to my stomach, even just now talking about it. But that's why to me, it's not worth the risk. And so don't put all your eggs in one basket. Diversify, and you'll do well. Okay. Now here's a quick look at between. This is the company stock in blue versus this is the Vanguard total U.S. total stock market index fund, which is, captures at least a little over 3,600 companies in the U.S. Great one, index fund that captures basically the whole U.S. market. Look at the difference in 12, nearly a 13% annual gain over the last 5 years versus a 47% loss. So once again, though, here's what you can do with employee stock purchase plan. Sell, take your 15% and then buy into something like that. And then you're going to capture the gains of both ultimately. And that's just, I'm not saying that's what to do with your money, but that's a great, single fund that's very, that takes the whole U.S. economy and U.S. market into account. And then you can capture that 15% in 6 months, and then long-term capture the whole U.S. market gain. That's why I say put it ahead of even the Roth IRA or the HSA, because you got that free money, and then you can use that money to fund your Roth or your HSA. You just took advantage of free 15% at that point. Any questions? Does this make sense to everybody? Okay, now we'll quickly go into capital gains versus employee stock purchase plan taxes, because they're a little bit confusing, and even capital gains can be confusing. There's different, the short-term versus long-term. If you hold a stock or whatever equity at least a year, you get long-term capital gains, which is favorable, at least now how the taxes work. Capital gains tax rates are lower than ordinary income tax rates, but if you sell it within a year, you're going to pay ordinary income tax. And that's why it's, typically best, if you can, to hold things long term. But there is also the fact of don't let the tax tail wag the investment dog. What matters more is your investing, not taxes. In employee stock purchase plans, it's different though. It takes from the grant date, it takes 2 years to actually become what's called qualifying, which gets rid of kind of typically the ordinary income portion of it. And we'll go through an example of it, but there's 2 caveats. So 2 years from grant date. So let's take this period we're in right now. Grant date is January 1st, 2022. So you got to wait 2 years from then. So January 1, 2024 is when it becomes qualifying, or it's actually and 1 year from the purchase date, which purchase date will be June 30th of this year. So a year from that would be June 30th, 2023, but it's an and statement. So that 2 year from grant date is the worst part. You got to wait another 6 months. I don't know why it's so much longer than a normal stock, but that's just the way it is. And we'll go through examples. I don't think you should really always worry too much about selling right away, because we're not talking about a ton of money every 6 months. You know what I mean? It's so when you're talking about the taxes, it's really not that significant. If that's like I said, don't let the tax tail weigh the investment dog. But we're going to go through a capital gains example in case people don't know about that. But in general, you buy some equity, some stock or index fund, whatever. That's the price you pay. That ends up being, and this is just like Kevin, like you were talking about, a regular, another brokerage account. This isn't employee stock purchase plan or RSUs. But if this thing goes up in value, and then you sell it, that profit, that change from that price you paid is the capital gain. The price you paid is what's called the cost basis. And then you'll pay taxes on that capital gain. And capital gain sits on top of ordinary income. So depending on where your income is, depend on what actual capital gains rates are. You guys have seen those before, but I've got a slide here that kind of correlates tax brackets with applicable capital gains rates as well. And then in a loss, it's just the opposite, basically. If you paid that much and then had a decrease in value and you sold it, that's a capital loss. And what you can do is use losses to offset gains, or you can get a maximum of like $3,000 a year in losses that'll lower your ordinary, that your income on your, that you see that determines your taxable income. You can get $3,000 off, and you can carry it forward. So say you had you lost $9,000 in capital losses. You could carry 3,000 forward each year. So for over 3 years, you could take $3,000 off your taxable income. Does that make sense? A lot of times, a good way to do this though is maybe take something that you're going to keep buying that you like, that you've made a gain on. You could sell that and rebuy it, and then you're upping your cost basis for that. Say that. Let me go back real quick. Say you sold something for a loss, and then you had a gain on this VTSAX. You could sell that where it's an equivalent gain for that loss that you had, net zero for taxes, but then you rebuy that VTSAX. So now you're at a higher cost basis. So as it goes up, you would pay less in capital gains. Does that make sense? That's kind of, I know I'm probably don't speak it too clearly, but hopefully that makes sense. And if not, just let me know. Okay, now we're rolling into employee stock purchase plans. So here you have that potential ordinary income, and that comes from that 15% discount that we get. And this is, this example is showing an obvious gain, but your adjusted cost basis includes that 15% discount that you would have to pay in taxes if you'd have to pay taxes on that 15% if you sold while it's disqualifying. We'll go through that. Okay, so it's just, I'll let you read here, but this just kind of shows the different forms. It goes what's on what. Ordinary income will actually show up on the W-2. The other things will come on a 1099 for your taxes. Okay, so just like I said, I wanted to quickly show what are the capital gains and loss tax rates. So the nice thing, and this is for when people say retire and they don't have any income coming in, like they don't have a pension, or say take a sabbatical and you don't have any income, you have a 0% capital gains rate up to single like 40,000, married like 80,000. So you can, that's a good time to do tax gain harvesting, where you don't pay any taxes, but you raise your cost basis. You sell at a gain, rebuy, and you keep doing that. And it's a great way to avoid taxes, but raise your cost basis. So when you sell it for good to spend, you don't pay, you minimize your tax burden. But then most people are at 15%. And then there's an additional for people that have a certain income. They've added this 3.8% tax that came in with the Obamacare for net investment income. But look at the California's capital gains rates. It's even worse than their regular tax rates, which is terrible. But I put this out just so we could see, could be for potential future planning where you're going to live, establish residency. Nevada has, Florida and Nevada don't have any capital gains. I mean, think about it, that's pretty significant when on a large capital gain, getting to keep that 13%, 13.3% that California charges, keeping that for yourself is pretty significant. So something to consider. Okay, now we're going to walk through the actual examples showing how to calculate what's the ordinary income, what you pay taxes on. I'm just using this example, the 10, 15, the top numbers, just because it'll go through all the examples, both with RSUs and employee stock purchase plan. But I put here the numbers for this company stock right now. January, 1st, it was this. That's where it was, and I just assumed, hey, assuming it stayed when I had looked at it yesterday, 31.25, if that was where it closed on the 30th, this would be what we'd pay. It'd be, 15% discount on that price. And that's what we'd pay. But I'm just going to run through these simple numbers using 10, 15, that 8.5, and then they sold at 22. So it's just easier for demonstration. Any questions here? Okay. As mentioned, this kind of shows the graph of when things are qualifying versus disqualifying with the stock plan. The big key is it's 2 years from that grant date, how ours works. Some different companies have different time periods that they actually use them. Some do quarterly stock plans, but this, how ours works, this is always the kicker. 2 years from the grant date, and then we'll go into with how different these different examples if you sold it qualifying or disqualifying. And this shows how much ordinary income you'll find on the left of, hey, it's the lesser of these two things if you sell it versus what you bought it at, or the grant date price minus the option price, what you actually paid for it as a purchase price as well. On a disqualifying, no matter what, it's fair market value at the time of purchase. So going back here, like we were saying for our stock, if this remained, like I said, if that was our close on June 30th, that would be the fair market value at time of purchase. That's what we bought it for. So you'd pay 31.25 minus 26.65 or 56, whatever. That would be what you'd have ordinary income on that you then have to pay taxes on if you sold it. But you can't have negative ordinary income. That was the bumper there. Okay, and this goes through the examples, like you saw in the qualifying, the lesser of those two things. So you see there's a lot less ordinary income by a qualifying disposition than a disqualifying, and it'll add some taxes, but as I'll show you in a minute, especially with California capital gains taxes, it doesn't really matter. It's not that significant that it should really impact when you sell.
Hey, Alan,
Okay. Yep.
would you please go back to the previous slide?
Mhm.
I'm trying to understand disqualifying disposition.
Yes.
You are showing here $6.50 per share. That
Yep.
was
So
that's the one that you are going to pay the tax on versus $13.50 per share.
No. Okay, so on the left, all the blue here is these two examples right here, the lesser of that $13.50 per share and the $1.50 per share. That's the thing if it's qualifying. So it's the less you pay, what counts as ordinary income is the lesser of those two calculations. So this would be significant, $13.50, right? But it's not. That's not what you use. That's why it's better, because you have these two potential options, grant date versus, that's your only ordinary income on the qualifying per share that you would pay taxes on for the qualifying. Whereas in this is all assuming you sold it, at the same price at $22 per share. You wouldn't, that's just the amount of ordinary income. This doesn't account for capital gains, but it's the ordinary income you'd pay, which is a different tax rate than the capital gains tax rate. But on the disqualifying, you've got no choice. It's just fair market value at purchase minus your purchase price. No matter what you actually sell it for, whatever price you sell it for, you're still going to pay, even if you had a loss, you're still going to pay $6.50 per share in ordinary income. Did that answer your question?
Yes, thank you.
Okay. Yep. Okay. So now we'll go through kind of Shama. This will go into a little more of showing, okay, we sold this many shares. Here's capital gains. Here's ordinary income. And then what we'll really be paying. And I added down here what we'll be paying taxes. And this is, I just used a 30% overall tax rate for ordinary income, and then assumed a 15%. And the California's ridiculous 13.3% capital gains rate. But you can see here, we sold 100 shares at $22 per share. That's $2,200. What price we paid? We bought them for $8.50, and then we already showed that $1.50 per share, right? Since this is qualifying, we have $1.50 times 100, that's $150 in ordinary income that we have to pay taxes on. And then a capital gain of $1,200. So I did the counts here for, okay, so we'd pay about $45 in tax. And then a total, you know, here's the capital gains we pay on that $1,200, $385 about total in taxes. Here's a disqualifying disposition that we just went through, the same thing where you're paying, sold the same 100 shares for $22, but now you've got ordinary income of $6.50 per share instead of $1.50. So you've got $650 of additional income. Now you'll see, you know, now you have a lot more ordinary tax you're paying, but especially since you were in California, those capital gains taxes eat you up anyway. So you're only paying, $393. It's not even $10 more than what you'd pay for the disqualifying. You know, granted, this is just assuming that overall 30% tax rate, but that's probably pretty good since it's a graduated federal tax rate plus whatever state taxes are. It's probably pretty close. But you see, there's not really much. Granted, if you weren't living in California, if you're one of those capital gains tax-free states, you'd get rid of that $93. But big thing, I guess the point is, it's not that significant when the amount of money we're talking about for most people, even up to, you know, 5% per year, if you sold immediately after you purchased, the difference in taxes are not going to be, it's not that big of a deal, I guess. You know, don't let that worry you. Okay, now, any questions on that? Did that all make sense? And we're going to go through some better tactics here shortly as well. Yep.
Alan, when you say disqualifying, let's say that June 30th, July 1st, we purchased it, and I decided to sell it July 30th. That's what disqualifying?
Exactly. Disqualifying will be if this current one that's going to close June 30th, if you sell it before January 1st, 2024, it'll be disqualifying.
Okay.
Okay. But Shama, you've already been in this ESPP for a while. So we're going to talk about ways that you can sell that equivalent amount of money, amount of shares that you've just bought, but using a different batch and not paying any taxes. Instead, maybe taking, we'll go into it. But now we'll talk quickly about RSUs. So RSUs are restricted stock units, and it's kind of taken over as what stock options are. They're actually no cost to the employee though. Stock options, you used to be able to actually put money aside, so you had to pay for it, and then you could exercise that option on a certain date. So that only was really beneficial if the stock continued to go up, and then you could exercise, you know, get that pay a lot less for the stock. But RSUs are basically, it's a incentive that the employers have where you get stock, and hopefully it goes up because of course that's just more money, but it helps, you know, incentivize people to do good work and stay around. So how this works is typically the award letters is in November is when RSU awards come. And if you don't have RSUs, one thing to point out is this might be something to negotiate with your boss if you're not already getting them, you know, as a way of yeah, it's just something to consider, you know, if you hadn't already, because I don't believe everybody has them, but that's something you could negotiate to get some additional money. But what it does is, so on that day that you get that award letter, that closing price determines, and pretty much I think anymore, it's just a certain dollar figure. They used to give just a letter said 300 shares or whatever, you know, 100 shares, 500 shares. Now it's usually a dollar value. So then what happens is, in this example I'm using, you get awarded $10,000 on that date, and the stock price closed at $25 per share that date. Bam, that quick calculation, there's 400 shares. So you get RSUs vest over 4 years, 25% per year. So each year on that next, you know, let's say you got this last November 17th, 2021. So on 11/17/2022, you'd get 100 shares, and 100 shares at the current stock price. So whatever it is on January 11th, 2022 will be how much, you get 100 shares at that price. So of course, you want the stock to be going up, because if it's dropping, you're ultimately getting less than, you'd be getting less than $10,000. Does that make sense? Still money, but you obviously want the money to go up. This one, notice the difference. ESPP, you pay taxes when you sell. As soon as RSUs are awarded, that's when taxes are due. It's just ordinary income. It's just like a bonus, basically. Same basic thing. Okay. Yep.
This is the first time I hear about the RSU.
Mhm.
I never heard this one before. How do you go about to talk to your boss and ask for it? Kind of embarrassing.
And this might be something you anybody else want to is welcome to mention here, but this might be something on a one-on-one discussion. If your boss is happy with your work, this would be something to bring up. And negotiating is never comfortable, I don't believe. Some people, I guess, like it, but I don't find it comfortable. But
I just have a new boss, like she's been there for less than, I would say, less than 6 months. So yeah, I just ignore my question.
No, I don't say ignore it. I would say when you, and this would be part of your, like, okay, when you're with your one-on-one with your boss, maybe you go over, hey, what things you're working on, metrics for getting to the next level, etc. Hey, this would be something you could say, like, I know Viasat has restricted stock units. That's something I'm very interested in. If you're, to me, if you value me as an employee, this is something that helps, retain people. What do I need to do to start receiving RSUs? There's a smoother way to probably say that, but does that make sense? I mean, it does.
They also have the manager reach out to all of us, like kind of semi-high performance to look into our rate, and then they up and ending, on our pay rate before the review. So that's what they've been doing like the last couple months.
Yep. And this is something to know, like, we're all employed here, but it's something when you're negotiating salary in general with companies, it's something to know whether they have this kind of thing on your research. So knowing that they have, like, in my opinion, you always go with starting salary. That's the most important thing, and get that as high as you can, because all your raises are based on that's whatever starting salary. So I like to think of it, get your year one raise day one, and then all your raises, it's a percent, right? So it's all gonna be based on that starting salary. So as high as you can get that's most important. After that, then we're talking RSUs, starting bonus, vacation time, whatever. Those are secondary in my opinion. But there are other avenues to negotiate after you get that top starting salary that you can.
Real quick, my last company, I'm not gonna mention the name, but they just give it to you like automatic, like you said, 4 year, 5 years you vested. You don't even have to ask if you're high performer. You just get it.
And that's good. But whether you're high performing or not, how much you're getting, you might have to ask for. Maybe you could get more if you asked about it. Make sense?
Thank you.
All right, you're welcome. Anybody else have any questions or thoughts on that?
Hey, Alan, this is the first time I'm listening about this. So thank you very much for bringing it up.
You're welcome. Anybody else have any thoughts or want to add on to, like, I'm sure there's better negotiators than I am here.
Alan.
Yep.
Aren't those generally offered as part of your compensation package when you start
Right.
RSUs?
Yep.
Yeah.
But they're also
Depends on the
something that you
level.
can negotiate later. Sorry, was that Ian?
Yeah, I would say that RSUs are not typical for like every entry level position. Maybe like mid-level if you're coming in like, you know, from another career or something like that. So I would say it's kind of case by case, but you can get it, yeah, like at, you know, signing or in lieu of a signing bonus. But I think it's typically performance related.
No, you're right, Ian. But I guess my point is knowing that a company has these or not, and asking about them, all they can, you know, it's like all they can say is no. You know what I mean? Not at this time. Prove yourself, and then we can rediscuss this. You know what I mean? But that's why it's important to know what the company can offer, and then to make sure you're putting yourself in the best position you can.
Yeah, I would say that RSUs for the company are like, this is also called like the golden handcuff. Like, it's for minimal cash outlay. You get to make the employee happy and keep the employee for a period of 4 years. Because for us, you know, kind of the rank and file, like, it's hard for us to walk away from that type of money. So we want to stay engaged with the company. So like, that's a benefit to Viasat.
Yeah.
So, and I would also completely agree with you, Alan. Like, it never hurts to ask, like, hey, like, how do I qualify myself for bonus pool? I want to grow. I want to get to that level. If they come back with a hostile attitude, then that's pretty telling about that supervisor or that HR person.
Yep, exactly. Or the company in general. Yep. No, you're absolutely right. Cool. Hey, Irene, just saw you come on.
Hey there.
Hey, good to see
Thanks
you.
for doing this.
You're welcome.
Sorry I'm late.
No problem. It's recording right now as well. So, and you know, you guys should have the link, but I'll post it once it's completed. So we were just talking about actually negotiating kind of outside about RSUs in general. So let's see. Oops, I didn't realize there was a chat. I'm sorry, I don't always can't pay attention to everything. Okay, that's someone just saying they got a drop. Okay, we'll move on to the RSU example. And this, we used a 40% tax withholding. It just makes the math easy. You know, these are just hypothetical, but it hopefully just makes sense for the example. And we're using the same values we did for the ESPP. So you got the on the grant date, it was $10. And like I said, say a year later when it vests, you know, that quarter invests, it's hopefully went up. And in this case, it's at $15. And then you sell it at 22. So we're talking basically the same, you know, same as we did with the employee stock purchase plan. That money is reported on the W-2. For your RSUs, like I said, you're taxed immediately on because that's basically income you've received. On ESPP, you pay for it when you sell it because you haven't really received it yet. And then when you sell these, you can't have short and long-term capital gains depending on how long you hold RSUs. But you could sell them immediately and basically have zero capital gains and just reinvest it if you want. But we'll go in. Here's an example and how you do taxes on it. The default method, so you get 100 shares at $15 per share, and then you got to pay taxes. Say we're saying 40%. That would be 60 share. You know, sorry, you have to. If we're talking 100 shares vest, you basically are on 40%. You'd have to. You could pay those taxes with those shares or with those 40 shares. You'd only end up receiving 60 shares. And that's the default when you get these, is how it works. And you'd have to go change that to an alternate means where you're going to pay the taxes yourself, basically, and then keep all the shares. My thought is, for me, I just use this, let them withhold those shares, and then it does a couple of things. One, I don't have to come up with that money, that cash right now to pay the taxes. And secondly, like I said, I don't want more than 5 to 10% of my net worth in company stock. So this, you know, I get more. I get only 60 shares instead of 100 shares and have to pay cash for taxes. So it to me, it's just a smart way to do it. If you thought the stock was shooting to the moon, you know, but that's usually like small cap companies, then it might be a different idea. You know, if you might pay in cash and keep those shares, because those shares might rapidly turn into something, you know, much higher value. But in general, just pay the taxes with shares. Okay, now we're talking about ordinary income and capital gains, similar to the employee stock purchase plan. In this case, like we said, we only got 60 shares since we paid taxes with 40 of those shares. So our net is $1,320. This doesn't count as price paid. We already paid. I mean, these are just given to us. It's ordinary income is what we had got the shares at. Remember, it was granted at $10, vested at $15, and then we sold it at $22. So we've got a capital gain of $420 that we'd have to pay, and that's based on long-term capital gain. So if you held it for greater than a year, if you held it for less than a year, that $420 would also be ordinary income. Any questions there? Okay, now we're going to get into what I think for people that have already been here for a couple of years and say have stock that they've just let sit there. And so, and given an example of, let's say, employees, just as an example, over the 6-month period, you ended up buying 100 shares at $30 a share at the end of June. So total value of $3,000, right? Now I'm going to show you, in case you guys aren't very familiar with the employee, this is the E-Trade page when you go onto your stock plan, and the arrows I'm showing, you know, where to go click on. So go click on your stock plan, and then I've blacked out these items, but this shows what's currently vested and your current day's gain. This shows your total amount, and that includes what hasn't vested yet. You know, so if you have RSUs, the value of those at the current market rate, what your vested account balance is, and then your total account balance. But click on that, and then you'll go to the next. This will come up here. It'll show you what percentage of your stuff is in employee stock purchase plan versus restricted stock. You go here, you say, yep, I want to sell. And then here I gave some examples. When you pull up the selling part, you see all these different items of date acquired. And I'm talking about, hey, there would be another column down here that would show, you know, date acquired 6/30/2022, right? Well, we don't want to sell that, because when we pay a lot of ordinary income, if we don't have to, we can sell a different batch of that same $3,000, because all this stock is the same stock, right? It's really all valued at the same, but you might have had some that was at a higher cost basis, and you can take a loss on that, and either use that to counter a stock that you want to sell that you've made a gain on, or you can decrease your tax burden that year, you know, up to $3,000 by taking a loss. So I gave 3 examples here. This one down here, I took an example of, hey, this is a much higher cost basis, $44.54. Now it's, you know, sadly at 30. But if you sold this, you would still, and this is not exactly accurate, you'd still have to pay ordinary income assume ordinary income on that fair market value of when you bought it versus the purchase price, remember from earlier. And then you would end up having a capital loss as well. But it doesn't really make sense to do that if you have qualified ones already. And we'll go to the next one. So you see the green and blue I've highlighted. So on the green example, you see this is qualified, right? So we've already, we have 0 ordinary income due. And you saw that the stock price was, the cost basis was, and sorry, this is assuming when I did this, it was, the price wasn't actually $30, it was like 31 and change, you know what I mean? the difference between 3262 and 129, but you would have a loss for this amount times the number of shares. So in this just quick example, that'd be you'd have a capital loss of $129 versus paying tax on 15% immediate gain. Yet you're getting rid of the same amount of stock, right? Does that make sense? So that's the smart way to do it. Take the loss. It's all the same stock, however many of this company stock number of stock shares you have, it's all the same. But if you can be strategic in how you sell it, you can put yourself in a better situation. So take the loss, and then you can either use that against your taxes, or sell other things that you get a gain on and have a win, and net zero. I took another example. Okay, you have restricted stock units too. Well, in this case, look at this cost basis. 53.43. This would actually be 23.43. The loss. So that'd be almost that'd be over $2,200 in losses that you would be able to use, even though you're just selling the same thing. You're selling the same number of shares of the same thing. You're just taking a better choice of what would make to minimize your tax burden. Does that all make sense? This is kind of, sorry, I don't know if I'm explaining it that well, but hopefully it makes sense, because it's important. People instinctively don't want to take a loss, but it's a lot of times the right way to go. You know what I mean? In this case, you're selling the same thing, so take the loss so that you pay less in taxes. Like that. Anybody have any questions here?
I have a quick question on E-Trade will flip the short term to long term, and I thought it was a year after the purchase date, but a few slides earlier we were talking about the grant date, purchase date, and all that stuff to make sure it's ordinary or qualified. So are we to trust what they're saying is long term and expect that to be taxed as a long term gain, or 6 months off?
I wouldn't trust them, actually, because Kevin, I think I've looked at it before. I'm like, that doesn't make sense. So that's where it's important to know, if it's RSUs, it's just like a regular stock. That day you get it vested, that's day zero. And so that's like normal short-term and long-term capital gains on stock. So you hold it for a year, then after a year, it's long-term. Less than that is short-term. But for ESPP, but I don't trust them, because I think I've seen errors on it, so I wouldn't trust that. But you have the information right there. If you look at it, right, it shows your purchase date. It does date acquired, so it shows that, so you know when it was acquired.
Which means you can be 18 months after that.
Right.
They're just going off a year to turn it into the long term.
Exactly. Which is so they're kind of, you can't, sadly can't really exactly trust them, but
okay. Well,
so, okay, is that makes sense?
Yes.
Any questions on that? I hope that's, to me, that's one of the most important things. If you've already had some and you want to slowly sell off some of, like I said, I'm a big believer in taking the 15% and then rediversifying it into more diversified portfolio. But I know that can be kind of confusing, but hopefully it's helpful to everyone. And then just a couple quick things. I was looking, just, hey, if somebody's terminated, they will get their cash back within 60 days if they had money, going away to this. And if there's somebody passes away, the beneficiary can ask for cash, or the stock plan will be exercised as it was already planned if no action's taken. And then, like I said, you can 10 days before you see the email come out, 10 days before the actual purchase, the exercise date, you can say, nope, I don't want to be a part of this. I don't recommend that, but that's an option. Now, just a couple quick things in the last few minutes I want to mention. It's been a banner year in the market, huh? Like we're in a bear market, and I mean, this is like tough times. Bonds are losing money as interest rates go up. Inflation's at all 40-year highs. It was 8.6 in May. Recession looming. We'll know probably in early June whether that is 2 straight quarters. And interest rates rising. They're mortgages are over 6%. So what do you guys concerned about investing right now? What do you guys think?
Dollar cost average.
Yep. And it's and yeah, I'm exactly. I'm a believer in catching the falling knife too. As they go on sale, as the market drops, it's more on sale. And as people closer to retirement, that's not you don't want that in general. But there are strategies you can use as well. That's the good time to do Roth conversions. So your money when your market value of your say your traditional IRA or traditional 401k start drop, then you can move that money in and recover it. And once it's already in Roth, when the market recovers, you'll get all that tax-free gain. So there are even for people close, if you shouldn't have all money in equities when you're close to retirement anyway. So you use the other cash bucket, other fixed income bucket. But the thing is, like we're about coming to a recession. This is, I think, a good slide that shows, look, the market's forward looking. It's when we're in a recession that the market comes back. It's not when we're out of it and everything's all joyous. The market starts taking off, and it takes off, you guys see, in a hurry, all of a sudden. So now's the time to be buying when everybody's fearful. Be greedy and start buying these in. And for young people, it sounds counterintuitive, but you should always want a bear market because you're just constantly buying at that low price, and it's going to recover. That's so don't be afraid of it. And then just another quick demonstration. Here's since 1926. Here's what the market's done. The blue is our bear markets. The orange is blues are bull gaining. The orange is the bear. Look at the difference. The average bull market, 8.9 years, a cumulative total return of 468%. Whereas every bear market, the average is about 1.4 years and loss of 41. It's painful when it happens, but that's the time you get that money in, dollar cost averaging in. That's how you make even better returns. Any questions there? Yeah, it's no whatever past performance is no sign of predictor of future performance, but I trust the technology and businesses will continue to make profits and will continue to be innovative, and the market will continue to go up. So just keep following that. It's an uphill walk up the mountain, like with a yo-yo, but just keep buying. Okay. Any quick questions? That's what I had for today. But was that, here's just basic questions. Let me know what you think, or if you have questions. Thanks, Shama, Ian, Kevin. So you guys have had several questions you've asked that we'll be addressing and hopefully, Ian, this answered kind of your question about, it was I did kind of the counter almost of it, of selling some of this Viasat stock at a loss, and you could take another stock as a gain. But the same thing works, if Viasat stock goes up, we launch and the acquisition of Inmarsat, and our stock goes up to 100. Yeah, sell some, and if you have some losers, you could sell those off and have it, have them negate each other out. And then here's some topics for next upcoming topics. If you guys in that Slack channel too, if you have any specific topics, maybe I'll do a poll or something. But if any of these sound interesting, let me know. The whole key is to present what you guys want to talk about. So, any other questions?
Are we voting on topics?
No, but we can. What I'll do is, maybe in the Slack channel, I'll say, here's option, the next topics. Give me and we could put different icons down for different votes, for different topics. But any of these that you guys see, any of these could look interesting to you guys?
Home buying.
Or more interesting than others. What's that?
Home buying.
Second that.
Make it back to a Roth. By the way, I learned there's other people that are also pressing benefits for this. So hopefully that'll happen. But But yeah, I can make it back to Roth. We could do quickly. I could do that and all about the Roth and 5-year rules in one topic. Probably be a good one. And of course, home buying.
Maybe you can touch inflation versus investing.
Yep. Yeah, Sean, you had good questions.
And I'm saying versus.
Yeah. And that whole topic that would be going into, hey, what's historically beaten inflation, and I'll even go into like, you guys have heard of TIPS, probably Treasury inflation protected securities, yet they're getting crushed, even though inflation's really high. It's like, why is that? But we can go into that versus, I bonds, which I bonds is something that's interest that you can only purchase $10,000 a year. But it's really a hot topic right now, and I think of it as a good, especially when people are getting closer to retirement. It's a great way to fill your cash bucket that's inflation protected, yet interest not affected by interest rates like regular bonds are. Does that make sense? So the TIPS are falling in purchase. They're going down in value. Because as interest rates go up, bonds go down. So these supposedly Treasury like inflation protected securities are losing money, which seems like totally counter to what they're supposed to do. That's because they're subject to an interest rate risk, whereas I bonds are not. They're just based on whatever the CPI is, and every 6 months they recalculate based on what inflation is. If inflation goes away, goes down to near 0 or 2% like the Fed wants, then it'll go back to 2%. But that cash money would always be inflation, keeping up with inflation. So it's a good part of a cash bucket. I think of it as a good CD ladder almost as you're getting closer to retirement. So, but we can
Alan?
we'll definitely go on that. Yep.
Question, what about dividend paying stocks to hedge against inflation?
Okay,
maybe you can put that on as a topic.
We can talk about that. Like, I'm not a big fan. Some people are big fans of it. Usually high dividend paying stocks are older companies, and so they're old, they're established, but Brian, I'm just about total return. So you buy the whole market, you know what I mean?
Well, there's also midstream companies, there's also REITs, right? All that.
Yeah, exactly. Oh, yeah. Yep.
And
REITs are good. Exactly. REITs are one that we'll go into. That's a good thing. It's like people that don't even own a home, you can get in the real estate, which beats inflation historically through REITs. But yep. So we'll get into that. But I'm already running over. Any other questions?
Hey, Alan.
Yep.
Thank you very much. It's very, very, very informative for me. Would you suggest very basic books?
Yes. So there's a couple, and my favorite. This is I like, especially for young people just getting started, is A Simple Path to Wealth by J.L. Collins. And Irene, I think several of you I sent this to a long time ago, but it's my favorite one for young people just getting started out, because there's all these questions like, what do I buy? And he just makes it so simple, and he's spot on, I believe. He's very good. Then there's I Will Teach You to Be Rich is another one I like. That one, I guess men tend to like more than women. It's Ramit Sethi. He's very kind of in your face. And so I think for some reason, though, I learned that guys tend to like him more than others. I'll put out a list, and also put out some podcasts that I like that people, and maybe some specific episodes from specific podcasts that I think are good for people to get a better, help building that foundation. Anything else?
Thank you.
Yep, you're welcome.
Much.
Thank you, Alan.
Thank you, Alan.
Okay, thanks everyone. Have a great weekend.
You too. Bye.
Okay, thanks. Bye.